Transitions, the podcast by Ostrum Asset Management.
Hello, everyone, and welcome to another episode of Transitions, the podcast from Ostrum Asset Management, aimed at understanding the challenges that lie beneath responsible investing. In a world where our usual reference points seem to be in flux, investing in stocks raises more questions than ever. With an unstable geopolitical landscape, shifts in the economic order, environmental and migration pressures, multiple transitions underway, and a heightened perception of risk among households, uncertainty is on the rise. Nevertheless, stock markets continue to show a degree of optimism, driven by new dynamics, particularly in technology and productivity. As passive management, which has been favored in recent years, starts to reveal its limitations in a highly volatile environment, this episode delves into the strategies and tools that investors can leverage to navigate through these transitions successfully. Is there still potential for performance in this uncertain world? Is it time to return to the fundamentals of active and conviction-based management? We'll explore these questions with our guest, Frédéric Leguay, Head of Fundamental Equities at Ostrum AM, and Juan-Sebastian Caicedo, International Equities Portfolio Manager. Hello to both of you.
Hello, Clément.
Hi, Clément. Great to be here.
First of all, given the uncertain world in which we live, what are your thoughts on investing in equities today?
There's this coined phrase in our industry. History doesn't repeat, but it sure loves to rhyme. Why do we keep coming back to that? I think it's for two reasons. For one, even though our job is to map out what next to market, we're always looking to the past for patterns, right? And that's all we have, right? And there's some truth to it. Economies move in cycles, some short, some stretch across generations. And right now, we're seeing several big ones hitting a potential tipping point. Debt, demographics, tech disruption, geopolitics, energy or climate policies, which tie into ESG. These cycles feed off each other, so it's no coincidence they're converging. The result is a world where uncertainty is spiking, but so is the need to make bold moves.
If I may, I'd like to come back to the debt cycle, as we have a clear feeling that the slow but relentless deterioration of public finances that we've been witnessing for more than 40 years is coming to an end. It's been a direct consequences, of course, of the effort from states to support economic agents in dealing with the management of this transition, but the imbalances that's created today worry savers as well as voters, actually, and we are fully aware that we are collectively coming to the end of this path and that difficult decisions are being prepared. Paradoxically, and on a more positive note, one can observe that in this world of uncertainty, listed companies are doing well. Even if questions about the sharing of added value and the distribution of wealth arise, it's obvious that large companies have successfully adapted to the rapid change in their environment and their value chain and are today more profitable and better diversified than before. They confirm a true ability to change that individuals do not possess. And in the current time, particularly with the widespread use of artificial intelligence, this phenomenon could be prolonged or even amplified. This is also reflected in the excellent performance of the stock markets.
Granted, performance in recent years has been remarkable, that's true. But the results also vary widely from sector to sector and region to region. To what can this be attributed?
Let's look back at the last decade. US stocks have outrun those of the rest of the world by what? About 7% a year? The NASDAQ, I believe, it's crushed global equities by 13 or more annually. That's an almost 400% difference against Europe in total return. These numbers are so staggering that for a whole generation of investors, outperformance has become synonymous with loading up on US tech giants. But there's more to this story than meets the eye. I think at least three under the radar trends have fueled this run. The first one is capital flows. Before 2008, so before the great financial crisis, the US owed the world about almost 10% of its GDP. I believe it was a 2 trillion figure against almost 20 trillion for the GDP. Now that number is closer to 90%. Roughly half of that 80% jump, so from 10 to 90, comes from foreigners snapping up a bigger slice of US stocks. And this has been turbocharged by unprecedented monetary stimulus and fiscal stimulus worldwide. The second element is the passive dominance. A recent Bank of America report shows that more than half of equity assets are now in passive funds, up from 40%, I believe, in 2019. These flows, driven purely by market cap without a glance at fundamentals or risk, are reshaping equity markets. Studies link this passive dominance to less elastic demand, especially among large caps. There's this great 2021, I believe, paper from a couple of economists at Chicago and Harvard that shows that for $1 coming into the market, it increases the total market cap fivefold. In other words, demand no longer adjusts to rising prices. They just keep getting bid up, starving out arbitrage opportunities. And the last point, and it's really a consequence of everything we've been talking about, is the concentration of risk. We've already discussed the huge performance differences between US stocks and the rest of the world, and the valuations that go along with that. For instance, the weight of the seven largest companies in the United States had never been this high, at least not since the beginning of the 20th century. The United States accounts now for almost 70% of the global market cap, compared to only 50% just a few years ago in 2015. What you need to understand is that even these numbers, as impressive as they are, don't tell the whole story. They actually mask the concentration of risk. Look at the Magnificent Seven, the seven largest US caps. They represent about a third of the total cap of the S&P 500, but they contribute to almost half of the total risk of the index. To give you an idea, 10 years ago, in 2014, that same contribution was only 7%. That shows you just how much the risk is concentrated in a small number of stocks. It's not something we can ignore when managing a portfolio. And well, all in all, this concentrated rally has been a wild ride, right? Partly built on fundamentals, of course, but also on flows and positioning and risks that are starting to hit their limits. You can't understand this year's markets move, for example, without grappling with these forces.
And yet, equity markets are at record highs despite their apparent accumulation of risk. Frédéric, how do you explain this?
Yeah, that's right. But there are several explanations to it. Let's look at some of those. First, we know our financial markets are momentum driven, and therefore it should not come as a surprise that their sustained performances of recent years continue to attract investors' interest. But beneath, we are also witnessing reallocation between asset classes. In a world where uncertainty is increasingly focused on the public sphere, for instance, private issuers are attracting more and more capital, obviously. Similarly, in a world that seems structurally more inflationary, real assets, such as stocks, present advantages, even if the historical rise in rates over the past few years does not necessarily encourage immediate rebalancing towards equity. Finally, and to refocus a little bit on Europe, as the world suddenly becomes aware of the profound change in the role of the United States in the functioning of the global economy, investors who, until recently, only had eyes for American exceptionalism, are now seeking better diversification of their assets. Europe, which represents half of the stock markets outside of the United States, appear as a natural destination for these reallocations, especially as large and medium-sized European companies are trading at a historical discount compared to their counterparts across the Atlantic. But we should also mention some favorable developments that we've seen during the last few months on the old continent. Thus, in Europe, we believe that we are witnessing a change in mindset. The Draghi report, which has been unanimously praised, is gradually becoming the new roadmap for the new Commission. The questioning of the budgetary dogma in Germany is also a manifestation of this. And likewise, I mean, the European Central Bank has clearly positioned itself to support the economy as soon as the inflation figures allowed it to. And in China, another example where economic difficulties over the past 2 years have been keenly felt in Europe, there is a more pronounced willingness to support growth in the face of the American tariffs, particularly to stimulate domestic consumption, which has been weak. All of these favorable perspectives, to which we must add reform in capital market, saving market, securitization market, as well as the easing of the competition rules or the widespread adoption of artificial intelligence-based functionalities, which are sources of productivity and growth, and which are likely to serve as foundation for a bull market in the coming months, and are clearly well received by stock markets.
So, based on what you've both said, how should investors behave in today's markets? How can they carry out these adjustments while paying attention to their underlying risks?
For the past year, I've been repeating this over and over. Stop chasing directional bets and start thinking relative, right? Forget those year-end predictions like S&P at 6,000 or 7,000 or Euro at 120. They're mostly noise and sometimes miss the real action. Dislocations across indices, sectors, and regions. With a risk-adjusted lens, relative opportunities are popping up, especially in Europe and Asia versus the US. Take European growth companies, for instance, with solid prospects. They're trading at a steep discount to the US peers, where absolute but also relative valuations are at record highs across most metrics. This relative analysis is also interesting from a macro perspective. The US economy is running at full capacity, which caps its room for more stimulus. Tariffs, if they kick in, could certainly dent global growth, but the risk is also inflationary in the United States. Europe and Asia, by contrast, have more fiscal and monetary flexibility. And I also want to circle back to the concentration of risk. On a valuation gaps between speculative and less volatile industries are near, I believe, 30-year highs. So based only on valuations, it seems like being prudent has never been so attractive. Several pockets among small caps and mid cap strategies, often overlooking the mega cap frenzy, offer undervalued opportunities too. Equal weight indices, indices where all companies have the same weighting versus cap weighted ones, also offer better diversification, especially in the US, where concentration, I believe, skews everything.
I agree. And even without mentioning the uncertainty of the actual geopolitical context, it's possible consequences on the price of oil, for instance. And after a price increase of more than 15% this year, mainly generated by a decrease in risk aversion and not by actual improvements in fundamentals, we believe that a certain caution is in order. Indeed, seasonality is traditionally not very favorable for equity market in the third quarter after the dividend period season. Second, I mean, the global economy could suffer in the third quarter from the backlash of the restocking movement initiated in anticipation of the establishment of tariff in the United States. I mean, in addition, I mean, weakness in the dollar, which is desired by the new American administration, is already weighing on the earnings expectation of companies of the old continent, and this could continue. The latter, I mean, the US administration also continues to blow hot and cold on the future framework of the trade relations with Europe and show great inventiveness, as evidenced by the recent legislative proposal on dividend taxation named Section 899. Finally, and even if our central scenario anticipates a significant easing of rates in the short term by the Federal Reserve, I mean, we are witnessing tensions on long-term interest rates that could ultimately disrupt the momentum of risky asset classes, especially in the United States. For us, this pause is going to happen, but it should be seized by investors to reposition themselves on European risky assets, which will continue to attract capital in the months to come.
Thank you, Frédéric. Given the multiplicity of all these factors, but also the uncertainty we're all witnessing, What fundamentals do you think should be respected when managing assets?
Well, first of all, and I'm thinking in particular of international assets, we just need to get back to basics. I mean, after a decade where the same themes kept winning, and now that positioning and flows seem so stretched, with so much US and dollar exposure globally, the concentration in global indices makes active diversification more crucial than ever. This goes beyond equities too. For 30 years now or more, stocks and bonds moved in opposite directions. Now that we live in a less globalized world, with inflation creeping back, rethinking diversification isn't just smart, it's just non negotiable. But I believe we need to go a bit further. Here's the market's big paradox. Passive investing feels like the rational move, but its dominance is making markets shakier. Efficient markets need everyone's views to balance out. When most investors just follow the herd, that breaks down. We don't talk enough about the need to stay active. I was listening to this podcast recently, and there was this Warren Buffett's quote, probably the greatest investor of all time, but certainly the person who quotes will remember best. And it was, your role as an investor is to remain cautious when others are not. And I believe he's saying two things. First, manage your risk, but also own your decisions. In the end, the market's resilience hinges on all of us playing an active role.
I agree. But I'd like to finish on a more positive note. I actually believe that the quote from Warren Buffett that Juan-Sebastian just mentioned was be fearful when others are greedy. But it contained a second part, which was, but be greedy when others are fearful. And I think that all the question regarding the end of the American hegemony and the various transitions that actually could contribute to it are also as many opportunities for large global companies, despite the regionalization of the world. I mean, the climate threat, the aging population, and the relentless digital revolution are global issues, and they offer significant growth opportunities, and particularly for Europe, where the investment needs are enormous and where there is a growing awareness among public authorities of the necessity for prolonged financial and regulatory support.
Thanks, Frédéric. Being able to exercise caution, remaining in control of your decisions, and spotting the opportunities that can arise from this uncertain environment. Thanks to both of you for such an engaging conversation. I hope it gives our listeners some helpful insights to navigate through this haze of uncertainty.
Thank you, Clément.
Thanks, Clément. It was great.
And a big thank you to everyone listening in. You can catch us on all our major podcast platforms, on our social media channels, and our website, www.ostrum.com. Tune in for the next episode of Transitions.